The fall of Silicon Valley Bank has dominated the financial news cycle recently. But did you know this is the second largest bank failure in the United States history? Yes, that's right. The top spot goes to Washington Mutual, also known as WAMU. WAMU's assets was valued at $307 billion at the time of its failure in 2008. That's almost twice the size of SVB on an inflation-adjusted basis. WAMU ended up being acquired by its competitor, JP Morgan Chase, at merely $1.9 billion, a fraction of its asset value. The acquisition was so controversial that some people called it the greatest heist in American banking history. Today, we're going to look at the rise, fall, and the extreme controversial demise of the banking behemoth, Washington Mutual. WAMU started in 1889 as a mutual savings bank. As a mutual bank, it didn't have shareholders and was owned by its depositors. Different to the typical commercial bank, the goal of a mutual bank is to serve its depositors, whereas the goal of a commercial bank normally is to maximize shareholder value, and providing service to the depositors is just the way to achieve that goal. So WAM really started out as a family-friendly bank that aimed to be a safe place for people to put their savings in. This has officially changed when WAM went public on the 11th of March 1983. The initial public offering of WAM stock was one of the largest in the US history up to that point, raising over $100 million. After the IPO, WAM gained significant market share by a few high-profile and strategic acquisitions. For example, WAM expanded its retail banking business significantly by acquiring Dime Bancorp in 2001, a New York-based savings and loan association. The acquisition gave WAM access to new markets and a larger customer base, and helped to drive growth in its retail banking business in the East Coast. WAM's banking business has grew to be the largest revenue source by 2007, generated over $3.6 billion in revenue. Its retail banking business became a key point of contact for customers. It also gives WAM the opportunity to cross-selling other products such as credit cards and mortgages. Now we have to talk about WAMU's mortgage business as it accounted for the majority of its profit. At its peak, it has a market share around 2.5% in the country. The company's mortgage lending operations generated significant revenue for the company. The mortgage business was highly profitable in the early 2000s as low interest rates and rising home prices led to a surge in demand for mortgages. WAMU was also known for its innovative approach to mortgage lending. It introduced new products and features that were designed to make it easier and more affordable for people to buy homes. For example, WAMU was one of the first lenders to offer subprime mortgages, which allowed borrowers with lower credit score or limited income to qualify for loans. WAM also introduced option adjustable rate mortgages, also known as option ARMs, which give borrowers the flexibility to choose how much to pay each month based on their income and expenses. These products has a wider target market and offered higher yields. Obviously, they are more susceptible to default and foreclosure, but people were happy to overlook that when the property market was strong. This aggressive approach to mortgage lending helped WAM become one of the largest mortgage lenders in the country, with a significant presence in the subprime mortgage and option arm markets. WAM's aggressive approach was well received by Wall Street and investors prior to the GFC. Its stock price opened at $2.75 per share on its first day of trading in 1983 and grew to its peak around $58 per share in 2001. By the end of 2006, WAM's stock price was around $42 per share, down from its peak in 2001, but still well above its initial public offering price of $2.75 per share. From 2004, the Fed has started gradually raising interest rates in the years leading up to the housing bubble burst in 2007. The interest rate was around 1% in 2004. By 2006, it has gone up to 5.25%. As the interest rate rose, it became more expensive for people to borrow money, and this led to a decline in the demand for housing. This, in turn, led to a decline in the value of mortgage-backed securities, which were the main source of revenue for many banks, including WAMU. In addition to this, when the housing market began to decline and defaults on subprime mortgages started to rise, WAMU was left with a large portfolio of risky loans that were unlikely to be repaid. This means WAMU will have to write down their value from its balance sheet, and it created compounded pressure on its financial health. In response to the tightening market condition, WAMU started aggressively downsizing its operations. In 2007, it reorganized its home loan division by closing down half of its home loan offices and removing 2,600 positions. In April 2008, WAMU announced a further 3,000 people company-wide layoff and closing down of all the remaining home loan offices. As the macro condition got worse, the entire financial services and banking industry was feeling the heat. All the share price of the large banks had experienced significant drawdowns, and a number of the banks have gone bankrupt. WAMU wasn't an exception. By mid-September 2008, WAMU's share price has closed as low as $2. It has been worth well over $30 in September 2007, just a year ago. While WAMU publicly insisted that it would stay independent, earlier in the month of September 2008, it had quietly hired Goldman Sachs to identify a potential buyer, but several deadlines passed without anyone submitting a bid. At the same time, WAMU suffered a massive bank run. Customers pulled out $16.7 billion in deposits in a 10-day span. All these events has led the OTS and the FDIC, government agencies regulating banks, believing that WAMU was no longer solvent. Eventually, the OTS seized WAMU and placed it into the receivership of the FDIC. The FDIC ultimately held a secret auction of WAMU. On the morning of Thursday, 25th September 2008, which happened to be the 119th anniversary of WAMU's establishment, regulators informed officials at JP Morgan Chase that they was ultimate winner. Now let's take a closer look at the events leading up to the JP Morgan acquisition, because they were highly controversial. Some people say that WAMU had enough cash to weather through the financial crisis, and the JP Morgan sale was a result of some unified and coordinated efforts among the OTC, FDIC, SEC, and JP Morgan. About 10 days prior to the sale, the OTC has reached an understanding that it wouldn't require the bank to raise additional capital at that time. OTS officials concluded that WAMU had sufficient capital throughout 2008. This is the same analysis made by the analyst and WAMU as well. 10 days later, OTS has completely flipped its position and said in a press release that WAMU was in an unsafe and unsound condition to transact business and has insufficient liquidity to meet its obligations. The problem is, the OTC has presented no evidence of the insolvency or any additional info to support its sudden change of view within a matter of 10 days. Some may say that the massive bank run has let the OTS change its position on WAMU. This may be a valid argument, but the OTS is an organization that has been regulating banks for 77 years, since the 1930s. Why it didn't account for the possibility of a liquidity crisis in the first place? On the 15th of July 2008, the SEC issued an emergency order to suspend all naked shorting for a select group of 19 financial firms. Unlike normal long position, people with short position profit when the stock value goes down. WAMU, one of the biggest banks in the country, was not on the list. The irony is that these banks were under no real short interest pressure because they were at that time in fairly strong financial shape relative to many others. Short interest ratio for a given stock generally lands anywhere between 1% to 4%. Due to not being included on the SEC's short selling ban list, the short interest ratio for WAMU rose from 25% in July to 32% in September. Failure to include WAMU on the naked short ban list allowed banks and hedge funds to short it down to the ground. This caused customers to be concerned, who then withdraw large amount of deposits, and then this triggered liquidity concerns by regulators such as the OTS, which seized the deposits after stating WAMU was no longer solvent. Now let's look at JP Morgan. JP Morgan became the single biggest winner in this transaction. Just to give you a context about how great this deal was to JP Morgan, for $1.9 billion, JP Morgan got WAMU's 2,200 retail banking locations, over $188 billion in deposits, and over $307 billion in assets. Upon completion of the deal, JP Morgan's management immediately wrote down $31 billion in assets, and this alone produced an immediate tax benefit of nearly $11 billion. What's more, JP Morgan didn't end up assuming all of Walmart's liability. Some of the liabilities were eventually assumed by the FDIC using taxpayers' money. JP Morgan was able to take out one of its largest competitors and expanded its market positions in the banking industry. On the other hand, Walmart's shareholders were virtually wiped out by the JP Morgan sale. Now, I'd like to know how you think about the JP Morgan deal. Do you think it is fair? Let me know in the comments section below. Overall, the failure of Washington Mutual in 2008 during the global financial crisis was one of the largest bank failures in the US history. It led to the loss of thousands of jobs, the closure of hundreds of branches, and billions of shareholder equities being wiped out. The aggressive and risk strategies that once led to Walmart's success also became the exact reason of its failure. The failure of Walmart also had wider implications for the US financial system, contributing to the tightening of credit conditions and increased government intervention in the banking sector. It serves as a cautionary tale about the dangers of excessive credits and the importance of responsible banking practices. A very applicable lesson in the current macro environment as well. Thanks for watching. I will see you next time.